sometimes less transparency to a client to help them have less emotional reaction can be a really positive thing.
At the end of the day, they want to know, are we on track? Am I getting my monthly check? Is everything okay?
So we have those conversations because it is a chief concern amongst our clients in the fixed income space. Absolutely.
That's Jay McAndrew, Vice President and National Sales Manager at Columbia Threadneedle Investments, along with Jim Cox and Rich Cefalio with Providence Private Wealth. We want to thank Jay and Columbia Threadneedle for sponsoring the ETF Think Tank Exchange, both live and the podcast. I'm David Jacansky.
And I'm Michael Guyad. Welcome to episode 201, the first episode of our second season of the Think Tank Exchange podcast. We're talking about dialing up fixed income. Thanks for joining.
Excited to be here with you, Mr. Guyad.
It's always a pleasure, my friend. Yeah, I've got a brief note for our audience real quick before we jump too deep into this. So if this is your first episode you're hearing, first of all, obviously, thanks for tuning in. Our focus here at the Think Tank Exchange is to provide thought leadership by bridging the gap between investment products and the advisors who use them through actionable ideas in real-world scenarios.
And in this podcast, we bring that to you along with our own Troso take. So let's jump right into the program where the discussion starts with our guest thoughts on active versus passive approaches in the fixed income universe.
You don't want to blow up in fixed income. You can't do it. People, that's an area where you have to manage risk. And having said that, there's a subtle balancing act between what exactly is active and what is passive, right? What we find in the ETF space, sometimes things that are coined passive are really, frankly, more active than people appreciate. Maybe Jay, you can comment on that in the context of your firm.
Well, absolutely. And I'll just try and confuse people more. And I say that facetiously, but what we've done at Columbia Threadneedle, as I mentioned in the opening, is that I'm a big believer that bond benchmarks are bad. And the reason that bond benchmarks are bad is because, as everyone on this webinar knows, that those companies or countries that issue the most debt tend to get the largest weightings in the index. And we don't think that's optimized. And as we're also all aware, most of these indices were really designed to be benchmarks. And I always think back to 1974 and the birth of the ERISA Act, which in its simplest terms said, hey, you want to have a plan for retirement money. You want to be diversified. You want to have a due diligence process. And finally, you want to be able to measure your managers against the benchmark. And the benchmark was never really designed to be a portfolio. I think what we're trying to do at Columbia Threadneedle is provide a different solution. And, both Mike and Dan, you hit on this, is that we're trying to improve investor outcomes. And I have some thoughts on that, a little bit later in the call. But just think about what's happened over the last trailing 12 months. Now, my numbers are a little dated because I haven't gotten the latest Morningstar flows. But think of this. $212 billion has flowed into passive, taxable fixed income. And my attestation would be that 99% of that is tracking what I would call a bad bond benchmark. So we think there's lots of room to improve the fixed income portfolios that investors are using. And I'll leave you with this last, hopefully, proof point. If you take a look at the AG, which may be the most popular of all ETFs and benchmarks, look at what has happened over the last decade. Something very meaningful for the rate environment that we're currently in. We've seen duration go from about an average of 4 years to 6 years, right? We've had the government issuing more debt, more longer duration debt. And you've seen your yield go from roughly 4% to 1%. So understanding the underlying composition of a benchmark in this case, or a portfolio in our case, we think is really important, because if you don't, you might be missing out on some of the consequence And I hope that point with the ag, I don't think anybody's saying, hey, I want to extend my duration, lower my yield, because in a low rate environment, as you know, rate changes could have a much more meaningful impact on the downside. So just a couple of thoughts on where we are at in the industry, Dan.
Rich, and any additional comment?
Yeah, I mean, along with our great partnership with Caroso, and we believe active management moving forward, particularly in the fixed income, is crucial to our book of business and our clients. Finding long-term returns, we think going forward, going to be a little more difficult than the past 10 years in the environment that we're in. So again, active management is going to be key moving forward here as we muddle this recovery, if you will.
So, Dave, the thing that really struck out to me of Jay's commentary here was this point about bad bond benchmarks. Oftentimes when you think about investing, you think about equities, you think about market cap weighted averages. And that doesn't really work in the bond market, because if you do the equivalent of market cap weighted, that just means you're giving more dollars to those which have more debt. And I think it's a really important point to kind of stress when you think about bonds.
It's funny. It's less of an issue nowadays than it was a couple of years ago, but that actually is such a difficulty to overcome as a manager in the bond space that ag actually underperformed the ag index quite significantly for years because of that.
And the only real way to sort of account for that, or to adjust for that rather, is to try to find those types of strategies in the bond market, those types of vehicles that purposely are trying to weight differently. And I think from that perspective, it's true. Not every single bond strategy or bond fund is the same, because the way it's constructed can actually result in more or less risk than most people think.
And there's really multiple layers of construction here, right? It's the active bets they're taking and the framework of future active bets that they might take in the future, right? It's not just how they're positioned today, but it's really the tools at their opportunity that you have to take into consideration.
Yeah, and a good way to kind of add to that too, right, is when you think about active management, it's obviously not just active in terms of the product itself, but it's an active decision by the advisor to find products that don't have that bond benchmark scenario. I think people have to realize that active investing is more than just about the strategy. It's actually trying to find other strategies that weight differently.
And to cut back into our segment, some things that are active are not actually active, and some things that are passive are not actually passive.
So with that said, let's segue into our next segment here on finding yield.
We've been big proponents for years of a barbell approach, getting both, right? And staying out of the middle. The messy middle is where all those interest rate moves take you out. Rich and Jim, we'd love to hear, because this is at the end of the day about that end investor, the persons that you folks serve. What are they asking for, and how are you delivering it? Like, what do they want out of their fixed income?
It's really an interesting conversation to have with clients. We've been in this low interest rate environment for so long, and we hear on our end is, okay, whatever our distribution or our monthly need is, it's yield. And what clients do not realize is they can lose just as much in fixed income as you can in equity markets. And is really sitting down with the client and educating them. And we wholeheartedly agree with you in the barbell approach. Also protecting the fixed income side, no different than the equity side. I think we've gotten away from what risks can be had with fixed income. And a lot of clients, many of them, do not realize the risks that they're taking in a low interest rate environment. I mean, recently we've had referrals come in and to see what other institutions are doing. It's actually, I don't use the word scary because we haven't gotten any interest rate hikes, but it's amazing to me that we get any move in the 10-year up 1% and what it would do to client portfolios. And we see a lot in the high yield space of people, even clients at other firms, reaching for yield in essence.
Taking on undue risk, if you want. And Mike, I'm glad you brought up the barbell, because of course we love that approach too, which is, really, our clients are looking for principal preservation, and we're trying to steer them away from really reaching out of their comfort zone for their portfolio to achieve a greater yield. So we love that barbell approach as well. It's worked out well so far, and I think as we move forward here through 2021 with some of the concerns with the dollar moves and possibly even to find better credit, moving down the scale a bit on credit without going to junk, of course. Nothing below B, I would say. And in fact, the double B right now, I believe, is paying around 5. So again, the barbell and the active approach, as we keep going back to, we think is crucial.
Rich, you bring up some great points there. And I'm personally, and again, I've been wrong on this, been very concerned about inflation, right? I do see evidence of food inflation, but I don't see certainly evidence now of rent inflation. But we all have to search out where there's value in the marketplace. So you brought up junk. I think now we call it, by the way, high yield.
Right.
I was around when that changed. Anyway, I think there is great value in the high yield space. It's how you qualify it, though, right? And it's what your screening process deals with. So Jay, maybe you can speak a little bit about how you guys, screen through on the high yield market, because I think there is value there.
Yeah, I mean, you're absolutely right. And before I get to the screening, I just want to take a point that Jim and Rich had made and extend it a little bit. If I had the opportunity to, if you think of the movie, Back to the Future, and you see the car pull up and the gull-wing doors open and you have the ability to hop in and you turn the flux capacitor back to 2006. We had an opportunity in 2006 to get a 5% yield from a portfolio of 100% 5-year treasuries.
Right.
And today, the challenge is, to get a 5% yield, you've got to be 83% in high yield, if I said that correctly, right? So if you need a 5% yield today, 83% of your portfolio would need to be in high yield, and that makes your portfolio about 60% riskier. And that may not be right for all clients. And so what we like in our portfolios, and we know this to be true, right? The high yield and emerging market debt might have been optional asset classes historically. Today, for income investors and for this massive demographic that we have moving into and living in retirement for longer, who needs the income, they may need to tap into sectors like high yield and emerging market debt that they never had to in the past. And so, that will possibly lead to a conversation of how do you actually access sectors like high yield and emerging market debt in single sleeves or in package solutions. But I would say to your point, Dan, as a firm, when we come together and we sit with our portfolio managers, we're always thinking about client-centric. How do we put the advisor in the best position to have a good outcome with their client? And so just some of the things we look at in not all of our solutions, but specific to our passive ETFs. When we look at high yield, we've made rules to exclude CCC. Why? Because CCC can be the volatility tail that wags the income dog. I mean, we want to go into high yield to be able to extract yield, but we don't want to get whipsawed by what can happen in the CCCs. It's similar in emerging markets where, again, across our firm, we do various things, but specific to our ETFs where we have to have repeatable rules, we said for income investors, let's be smart, right? Let's use only dollar-denominated bonds because we don't want the currency volatility, that can be as high as equities affecting a bond portfolio. And let's just bet on governments rather than corporations. So, in the work that we do in our ETFs on the taxable side, our EM exposure is dollar-based. It's all sovereign, not corporate. And we think that can, help investors achieve better outcomes over time.
Here at Treasury, we've been focused on barbelling our risks across the board, but most specifically in really striving for yield in your fixed income portfolio for quite some time. It's almost a game that the Fed is playing where they're trying to incentivize you to take more and more risk, and finding some semblance of stable income in your portfolio is becoming harder and harder in this environment.
Yeah, and I think one of the things that I very much appreciated about what Rich was saying in the discussion is that, at his firm, they're purposely trying to steer away their own clients from trying to reach for too much yield, which results in too much risk, and making them in some ways feel uncomfortable in doing that, which is actually what you want. Because if you're in a comfort zone when you're investing, you're complacent, and that's where accidents can happen. And I think that barbell approach is one that's really critical to help manage not just returns, but also expectations in terms of volatility and how one would react to that in their own investment portfolios.
If you think about what you're really trying to get from the fixed income allocation in your portfolio, it's yield, duration, and some semblance of negative correlation. And the yield side of it is the dangerous side, because the further you strive for yield, the less correlation benefits you get in your portfolio.
And it's also obviously, about the right kind of yield, right? So, and I think this kind of brings up the point about having repeatable rules and constructing a bond portfolio where it's not just U.S. and considering things like emerging market debt, which is a key component, I think, to having a truly diversified income allocation. And recognizing that for advisors and clients may not necessarily want to be in emerging markets as a standalone income product, but if it's blended in with something else, it might actually be better in terms of their perception of that allocation.
Yep. Next, you'll hear from our very own Mike Venuto on managing risk in the fixed income space. First, we want to thank again Jay and Columbia Threadneedle for sponsoring this program.
So, Jay, I want to take that and get back to this barbell concept, because I hear what you're saying. We've always approached it, or for the last 5 or 6 years, we've approached it as, let's have a safety component and let's have a high yielding component, not necessarily always just high yield, but could be combinations of things, EM debt or leveraged closed end funds or high yield credits or buy rights, whatever. When we've used traditional like treasuries, we're not using those for fixed income in a lot of ways, right? We're really using them as an alternative to alts, right? Because what we're used to getting or want to get out of alts, you actually get best from a 20-year treasury. So I kind of have one question, but I want to go to Rich and Jim first on it, and then come back to you, Jay, about how Columbia looks at this. So Rich and Jim, I know as we've talked in the past, having that barbell, although the end result is awesome, explaining it to the clients isn't that easy, right? Because we're going to have one component of the portfolio that's yielding 6%, 7%, 8%, but has got the volatility that looks like a 3 times levered EM fund. And then on the other side, we've got short-term fixed income or long-term treasuries and things like that. How have you found it with explaining that to clients that, hey, don't look at this one position, look at these 3 or 4 together for the end outcome?
Yeah, that's a great question. And we do dive into that with the clients. And I think it is a combination of showing them, as Rich points out, our holistic approach and really not, honing in on the specifics in the account, but looking at it as a whole, and how the whole principal preservation and adding, some of that fuel for some additional yield, helps the portfolio perform that much better, and at the same time holding back some of that risk that they are worried about. Because as we pointed out, the clients a little bit risk adverse, but boy, they still want their yield. So it is a tough waiting, if you will. So we have those conversations literally on a daily basis because it is a chief concern amongst our clients in the fixed income space. Absolutely.
Gotcha. So Jay, how does Columbia look to solve for this, like this statement risk issue? Tell us a little bit about this concept, right? Because they want it, they need both, but it's really hard to do it in one story.
Yeah, no question. So a couple of thoughts. Number one, in a persistently low rate environment, as I've mentioned, investors might be moving out the credit spectrum to try and increase their yield and their return. And Morningstar, through their use of investment versus investor returns, has been publishing some really fascinating stuff. And I do have bad news. And the bad news is that investor behavior in bonds is almost as bad as it is in equities. So what do I mean by that, right? And I've got the charts. If you want to connect with me or reach out, I can share with what Morningstar has done. But when you go out the investment spectrum, just as a hypothetical, in high yield, over 5 years, the difference between the investment return and the investor return is close to 1.7% compounded. In emerging market debt, the number goes up to 2.7%. So, behavior is something that we try and manage or think about to try and improve investor outcomes at Columbia Threadneedle. And that's why a few years ago, a little over 3 years ago, we launched a multi-sector solution for really that reason. When you think of the evolution of the ETF investor or advisor, for the last decade or 2 decades, they've been using single sleeve approaches. Usually these single sleeves are benchmarked towards indices that are benchmarks. And I've already talked about bad bond benchmarks. And the other thing is this: we just want the advisor to be able to get in passive what they can get in active. And when you look in active, $250 billion in multi-sector solutions. So advisors really like multi-sector active solutions. Why wouldn't we be able to do something and use our firm's expertise in multi-sector fixed income solutions and roll something out in the passive world? But a lot of this just goes back to managing client behavior. And Mike, you touched on it. We want to put the advisor in a position because we know their job is a monthly statement manager. And when you see line items for what I would call esoteric fixed income sectors to many investors, like emerging market debt and high yield, they may be reticent to keep them in tough months. So we think the packaging approach really works. You and I have worked together for a long time. One of the things I like to say, I'm a product. I grew up in the 80s and 90s. So, and I went to college and ate a lot of Prego. Think of the tagline of Prego, right? The old Italian father with a young Italian son making Sunday night dinner. Do you need the oregano? Do you need the tomatoes? Do you need the onions? No, Dad, it's all in there. And so we think using solutions that have all ingredients or a majority of ingredients in there can really improve investor outcomes. And we think there's certainly a packaging alpha to that. I will end with this point. Sometimes less transparency to a client to help them have less emotional reaction can be a really positive thing.
Jay, you just brought up an interesting point when, everybody, I think, well, maybe not everybody, but most folks, generally speaking, are afraid of emerging markets, right? And in equities, the classic traditional benchmarks are overweight by state-owned companies or state-owned enterprises, right? When I look at the emerging market fixed income area, it's uniquely positioned in some respects because you got the backstops of large enterprises, right? So it's your value sleeve, perhaps in the fixed income, that can add some value. I don't know if this question is directed at Jay or Rich or Jim. All three of you can chime in on this, but when you don't have to talk to a client about emerging market, I know that's a good thing, right? It's just the way it is. Who wants to tee it up? Who wants to talk about that?
I would say we as at Providence Private Wealth don't get that deep in the weeds. We will with Taroso, as far as making sure our clients are protected and understanding what's in each of these ETFs that we have in our portfolios. But we've never really gotten that deep in the weeds with the client. At the end of the day, they want to know, are we on track? Am I getting my monthly check? Is everything okay? That's really, our clients are entrusting us to make the right decisions.
Well, Jim, by the way, thank you very much for complimenting Taroso for its due diligence process. We do appreciate that.
Absolutely.
Hey, Dan, I would add a couple things I've already touched on. Certainly as a big active firm, where we can be all over with our opinions on emerging markets in certain countries. As I mentioned earlier, in our passive solution, we're a little bit more rules and regimented in terms of using specific dollar bonds and betting on sovereigns over corporations. But I want to come at it from a different angle relative to sort of the genesis of this entire conversation, which is about improving investor outcomes, right? And so, when you think about why you would want to include emerging market debt, well, because it's an opportunity set. And it's an opportunity set that tends to have the second highest amount of yield. So just as a backdrop, when we've developed some of our taxable fixed income portfolios, emerging market debt has a significant weighting, 20%. Now, the most weighting that we have in a particular portfolio in our ETF lineup is 30% in high yield and then 20% in emerging market debt. And the reason that is because when you think about the need of investors for income, we wanted to build a solution that was aligned with the sectors of fixed income that produced the most income. So, high yield has the most weight in our portfolio. Why? Because it produces the most income. Why does emerging market debt have the second highest weight in our portfolio? Because it produces the second highest amount of income. Why do treasuries have the lowest amount of exposure in our income portfolio? Because they don't produce a lot of income. So, back to this concept of what used to be a potentially optional asset class or fixed income sector in EM and high yield, in some of our portfolios, they're the lead sectors, not because, we watch the credit spreads and all of that, but it's because in this environment, they produce the most income. And that's what we need to get to the 3 to 5% that we might need to provide to clients. So a little bit of a different perspective, but we're always thinking about it.
We just heard the risks of emerging market debt and really trying to figure out how it fits into your portfolio. Is this something that's warranted as a standalone investment or something that's better as a piece of a packaged product in the fixed income space? We do know there is significant statement risk with clients for some of these vehicles that have more volatility than clients might want to expect in the fixed income space.
And it's interesting, right? Because where that really comes from is home bias, right? Because most people tend to invest in what they are most familiar with, which is their own country's bond markets and investment universe. And that's actually in many ways where the opportunity, why the opportunity exists to go overseas, to go international, because not too much money, at least from the US, may be chasing those higher yielding emerging market debt issues. But that statement risk is a really critical point. And I think any advisor that's listening to the podcast probably can relate to it directly, where somebody sees a line item on their statement, their clients see emerging markets, and they start worrying about trade wars and China and globalization, even though that really is almost irrelevant. From the standpoint of constructing a portfolio and having a mix of investments to diversify with. To have it within a packaged product so that the client doesn't necessarily see the name but still has exposure to those factors, I think is actually a wildly important thing to consider for most advisors when they're trying to put money to work for their clients.
That day-to-day headline noise is what also, quite frankly, creates the opportunity, right? And that's why sometimes it's better off as a piece in an overall portfolio, because it does need to be rebalanced, which means when things are going poorly with that investment is when you need to actually reallocate it to it and vice versa. And that's much harder to do sometimes when the client is seeing the end actual investment and maybe getting nervous at the wrong time in the market.
And by the way, you and I have talked about this quite a bit before, this idea that, rebalancing is also an active decision, right? In this kind of construct of active versus passive, you don't necessarily have to make a thematic bet, but the actual rebalancing process, which time and time again has been proven to significantly result in better returns and better risk-adjusted performance going forward. Doing that, especially within this sort of pre-packaged type of an approach with emerging markets, with high yield, with a mix of bond investments that are better than those bad bond benchmarks, that is active in a different way than most people think.
Even down to the time of day when you execute the trades, right? People just kind of assume a rebalance happens on a certain day and you get the same price, but that's just not the case.
And little things can make big differences in portfolios, and that's why this stuff is really important to think through.
Especially when you're dealing in the fixed income marketplace with such low yields and every basis point matters.
Couldn't agree more. As we near the conclusion of this podcast, we always like to end on a high note. I think it's important to recognize that investing is more than just making money. Personally, it's about making an impact, hopefully for others, spreading the wealth around with those better returns, hopefully over time. So here we have Jim talking about what they believe is important and is a charity that they are big believers in.
Tell us the charity that we want to share with the group today.
Would be the National Kidney Foundation. Kidney disease actually runs in my family. I had an uncle that passed away from it. My dad had a kidney removed, and polycystic kidney disease he had, and also my oldest son got it as well. So great organization. It's kind of, I say it's not your sexy disease that people go contribute to, but it definitely affects a lot of people.
As we wrap up this episode, we'd like to thank Columbia Threadneedle for sponsoring this podcast and the live show. Learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
How much think tank could a think tank tank? Think tank could think tank?
I'll tell you in the next episode.
That's because our value proposition is to enhance yours.
And I'm Michael Guyad. Keep the exchange of thoughtful ideas going. Until next time, be well.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such. November 2020.